Hello everyone, welcome back to the channel. Well, today, Sunday evening to be exact, we got some major news, huge news before the week has even started. The weekend not even over, and the Federal Reserve, the FDIC, the Treasury just dropped a bomb, a nuke on the market, and this is absolutely crazy. So we are going to be seeing the Federal Reserve intervening in this bank run catastrophe that we've been having. They are not bailing out Silicon Valley Bank, but they're like wink, wink, nudge, nudge. Yeah, we're bailing out Silicon Valley Bank. We're going to jump right into why this is different than a real bailout, what this implies for the market, what this means just for the future. I'll just show you right now what the futures are doing. They're going crazy. I mean, S&P futures, we've already gained all the losses that we made on Friday. So futures right now are up about 1.5% on the S&P. Nasdaq up about 1.5% as well. U.S. 2-year bonds falling off a cliff. I mean, they are falling off a cliff. This is the bond market right now is saying that the Fed will not only not do 50 basis points, but they might consider not doing any rate hikes. This might be the break, the break in the system that actually makes the Fed take their foot off the gas when it comes to these rate hikes, because we are seeing 2-year bond yields are just dumping. This is the quickest drop in 2-year bond yields, I think, since 2008. It's just crazy. It is falling off a cliff right now. So just crazy news, but let's just get right into it. So I won't read this whole thing, but today we are taking decisive actions to protect the U.S. economy by strengthening public confidence in our banking system. SEP will ensure that the U.S. banking system continues to perform its vital roles protecting deposits, yada, yada, yada. After receiving a recommendation from the boards of the FDIC and Federal Reserve and consulting with the President, Secretary Yellen approved actions enabling the FDIC to complete its resolution of Silicon Valley Bank in a manner that fully protects all depositors. So you might be wondering, how are they doing that without bailing them out? Well, they are doing what they call here a backstop, where basically the Federal Reserve is going to print up. Now they're being very clear. They're telling everyone, no, the taxpayer is not bailing this bank out because they don't want to lose all credibility already. Even though I'm going to get into that too. Like, what this does to their credibility is a complete joke. They are flinching. This is them flinching big time. They are panicking right now. So they're going to set aside $25 billion, give it to Silicon Valley Bank. That's not going to cover all their debts and everything, but that will cover deposits. So what happened here at Silicon Valley Bank? I visualized it like a 5-year-old, very rough visualization. This is what every bank does. Some banks are worse than others, and that's why Silicon Valley Bank went under. So you're little Billy, and you just got your allowance, and you're like, hey, Ma, I need to put it in my bank account. Well, you take it to the bank, you give them your $20. They don't just put that $20 in a drawer. They put that $20 into different securities. They usually go with bonds. They usually go with very not risky assets. It depends. But there are people that work at banks that are their risk management teams that manage the risk on where they take your money. What Silicon Valley Bank did here is they took investors' money, which they were not investors, depositors' money. They were taking it and putting it in bonds over the past like 10 years or so. All this tech money. They're the big startup bank. They're the bank that is willing to give lines of credit to these startup tech companies that make basically no money, but they are the risky creditors. They're the ones who are willing to give risky lines of credit to these companies that make like no money because they were taking these risky investment ideologies, I guess, and they were outperforming. But now that interest rates have gone up, they were buying risky bonds. So they were taking your money and they were buying risky bonds, which was all fine and dandy the past 12 years when interest rates were at zero. But what happens when you jack up interest rates is that these risky bonds, they lose value big time. They lose value. which isn't an issue unless you start to get bank runs, unless it becomes an issue, really, unless the public perceives that there is pain at this bank. So what the Fed is going to do is they are going to be like, all right, we'll give you 25, give that to you, SVB. And what SVB is going to give the Fed is basically some of these shitty bonds that they own that no one wants right now. They're going to give them that. And the Fed is going to hold on to that because they're confident, but that 10 years from now, those bonds will go back up in the value, and then the Fed will sell them 10 years from now. But they're giving them this 25 bills, buckaroonies. They're giving that to them so they can give you your money back, the depositors. I know it's a really good visualization here, but stick with me. So they're not bailing out the bank to keep it open. They are bailing out the depositors, basically. They're not bailing out the shareholders. If you own any stock in it, you're done. I mean, the bank's basically closed up. The FDIC owns it now. But this is a very drastic step. This is a incredibly drastic because on Friday, Janet Yellen was coming out and she was saying, no, we're not we're not bailing these people out. But them doing this is a real moral issue. This is 2008, not 2008, but what led to 2008 all over again. The thought that you can do very stupid things with depositors' money. You can take your customers, their money, and you could do stupid things like put it in the risky assets. And if things go tits up, the government comes and bails you out. So why not do the risky things, right? That's what you do. If you're not going to do the risky things, the other banks are going to be better than you because they're going to do it, and they're going to do it because Papa Powell is going to fix everything if anything goes bad. So that is the moral dilemma here when the Fed does this. So short term, this is fantastic. Futures are just going absolutely crazy on really high volume. For a Sunday night, this is crazy high volume. Like, this is big buying. And it's very curious. They released this news 15 minutes after the futures market opened. And look at this. Look at this candle. We jump up a full percent in this 5-minute candle. Just skyrocket. Like, this is crazy good news. So what this implies now is that the Fed, the FDIC, they must see something that we don't. They must be shitting their pants, seeing something that we are not seeing. Because if they are this drastically, if they're so worried about bank panic already, when after this kind of event, then they must know something. They must be looking under the hood of the whole system and being like, shit, man, this is going to get bad quick if we don't do something. So that's why, in my opinion, this isn't like, oh, this is great, the Fed is bailing out a shitty bank again. It is more so, oh, this is just the way things are. We are just, now if you fuck up, you're too big to fail. Too big to fail has never been truer. It's just crazy. So now look at our Fed futures. The possibility of that 50 basis point hike, gone. It's gone. It's at 0% now. Now the market has a 6% chance that they're going to cut rates, or they're gonna no they're not gonna cut, they're going to pause, they're not even gonna do a hike, which is crazy. So this whole event might have started the Fed pivot. This could be the Fed pivot, but then we have to ask ourselves, so this is why this week is just so crazy. I mean, this is such a crazy event that obviously right now stocks love it, the market is going crazy, but now we have to ask ourselves, well, the Fed doesn't want to start a banking crisis to get rid of inflation, but a banking crisis definitely would help stop inflation. But they're obviously, now we know that they are the weak, spineless Fed that they always are. They're always going to do this. History always repeats itself. The first sign of trouble, they bail it out. They come to the rescue for better or for worse. I mean, it's up to you. That's up for debate, but this really is crazy. So now we are seeing a very dovish Fed, and now the market is pricing in that we're going to be getting only 25 basis points, or that we might just not even see a rate hike at all, which is crazy. It is crazy. So that is this is the first sign of major pain that we are getting from these interest rates, because I've been saying recently, I've been watching my videos, like I've been saying, like, why should the Fed be taking the foot off the gas when nothing's really broken? Like, unemployment's still low, banks aren't, nothing's happening. This is the first, like, a crack. This is the first crack in the system, in the foundation of the house that is the U.S. economy. And it is a contagion. That's what they say when they call it a contagion. They don't want a contagion to spread, because this bank owes money to other banks. They have money from other banks. They have money from businesses. Businesses aren't going to be able to, if you're like a small tech startup and you had your money in this bank, you're not going to be able to pay your employees if you can't get your money out. They're not going to be able to pay their mortgages. It can just cause a whole contagion. It just ripple. If it's crazy. That's why these things are so, it's such a huge deal. It really is. And it's sad, because it's just stupid. It's just really bad risk-taking, greed. It's always greed. Always greed. And now you might be asking, well, why didn't they know this would happen? Well, they were so cocky, they thought they would just be good. They just thought, how could things go bad? Tech has been making so much money. Why should we worry about our underlying assets shit in the fan? They didn't hedge themselves for high interest rates. This is what the other banks have to do. You have to hedge yourselves. These other banks are smarter than this shitty Silicon Valley bank. You have to hedge yourselves for a higher interest rate environment. And they clearly did not, because the first sign of trouble, and they're just like, well, shit, everyone's money's gone. We don't know what happened. So this is just a monstrous development. We do have another bank, Signature Bank, that went belly up today. Yeah, they just got closed. And the Fed's going to be covering that. They're going to be covering Silvergate and Silicon Valley, I believe. So this is just, it's crazy. Yeah, I mean, it's crazy. This just changed everything, literally in one day. So now, tomorrow, I mean, look at the Fed, look at the futures. I mean, tomorrow we could see the biggest green day we've seen in years tomorrow. This could be an absolute change in the entire arc of this market. And man, this is why this market has been so crazy, because I know I bought a put or two on Friday. I was thinking, man, this looks bad. I think shit is going to start getting very, very bad. And now you wake up on Monday. I mean, now you wake up before Monday even starts, and you're getting destroyed. I mean, if you shorted on Friday, man, you are going to be seeing some green tomorrow morning, man. So that's going to be painful. This has just been a brutal market. Things just change so quickly, back and forth. You never know what's going to happen. And this is just another one of those examples where it's just like, no one could have seen this happening. No one thought the Fed was going to come out and bail them out. But the fact that they are is really, to me, like a red flag. Like, they're like, wow, they're seeing something we're not seeing. And that's always how these things happen. It's always something that no one thought could happen, no one thought would happen, but then it does, and they're just like, shoot, we didn't really think it would happen. It's always how it happens. It's always the banks are, we got your money, we can cover your deposits, and then shit hits the fan. The CEO of this Silicon Valley Bank, he sold like $3 million worth of stock 2 weeks ago. The dude's out there selling stock. He's selling his stock. He doesn't even want to be a bag holder for his own company. It's just crazy. You think people would get arrested for this kind of crooked behavior, but this is the Fed coming out and saying, yeah, this is not a fair game. If you make a shitty investment, if you're just a normal person, you make a shitty investment, especially if you make a shitty investment with other people's money, you usually get punished by losing that money or facing some consequences, but not today. That's not how the world works. So this is just crazy. This is absolutely changes everything. So now I don't even know if a bad CPI report is going to matter. Honestly, that's how huge the implication from this is. This is how big of a change this is that maybe now inflation, bad inflation data just won't even matter unless it's really, really bad. But or this could be a sign that the Fed is willing to take their foot off the gas, because they do think that inflation has been tackled, that it is actually on its way down, that maybe high inflation for these past couple months was just a fluke, and they're seeing enough data that inflation is actually tackled, which that would be a good thing. I'm highly doubtful of that. In my opinion, this makes the Fed just look so weak. And that's the thing with inflation, is that half of it is posturing, is appearing that you're going to be tough on it, that you're not going to just back down the first sign of trouble. And the Fed was saying that over and over. They're like, yeah, we can't. Yeah, things are going to be bad, but we're not just going to back down the first sign of trouble. And this is exactly what they're doing. They're backing down first sign of trouble. It's absolutely, I don't know. It's just crazy. It's wild. This was not what I was expecting to see on a Sunday afternoon, but man, does this change things. So I knew they were going to have an emergency meeting on Monday, or tomorrow, but it seems like they already dealt with their business today, because this is a big change. This is a big move. So let's look at the chart now. Now, we are not out of the clear chart wise. Obviously, this is a bullish development, so I'm going to be looking for upside. We do have a trend line right there, but kind of have to make a higher high. I kind of need to see SPY at least make it above 39.40 for me, personally. But above that, it's just a huge supply zone. I mean, we just have a monstrous supply zone. So much selling went on right here from like 10 o'clock on Thursday all the way to the end of the day. So there is still a lot of sellers hanging out up there. That will be the big one, I think, especially with this lineup here at 39.54. So we get above that, mount above that. We break this trend line. Then we obviously, next big supply zone at 40.20. But this could just be a type of thing where technicals don't matter. The chart doesn't matter. The market could just go straight up tomorrow for a lot. It could go up a lot. Like I don't know how many times I have to say that how big of a development this is, but it's wild. All you have to do is look at the old look at the bond. I mean, this 2-year drop is shocking. This is crazy, dude. Looking at the daily on the 2-year bonds, like, yeah, this is the quickest collapse that we had since like COVID. But COVID, I mean, that was COVID. This is just wild, just crazy. So another curveball from the market. If you're in shorts, man, it's rough. That is a rough L to eat tomorrow, because you just, nobody saw this coming. It's just one of those things, man. You just don't know what's going to happen. You have no idea. So you have to manage risk. You cannot go crazy to one side, crazy to the other side. You have to manage your risk, and this is a good example of why you need to do that, because you never know what might change. Looking at the Nasdaq futures. Nasdaq futures are looking fucking nice. I'm not gonna lie. We just got a golden cross now with that 50-day moving average crossing above that 200-day moving average on the Nasdaq futures. And it is bouncing at a really key support at 1193 down here, right where that 200-day moving average is. So if Nasdaq can remount above 1227, then we look great to the upside on the Nasdaq. But I can see a pretty clear looking trend line there. Get back above that. It's just supply zones. We got supply zones here, supply zone here. So just got to break back above those. And then really key level up here where you can see this is really where the head and shoulders started up here. That was a nasty head and shoulders. So 1238 up there on the Nasdaq as well. But yeah, I don't know what to say. I don't know what to say, man. Things are just gonna be going up for a while. Like, this is just such a huge development. This is the Fed is pumping again. They're printing $25 billion to bail out this really stupid bank, and now other banks are just going to see this and be like, well, business as usual. We know we'll just be good if shit hits the fan. But yikes. So that's all I got for you guys. This is a long one, but man, just a crazy development. Truly did not see this coming. So I would just ask you to consider, please, hitting the subscribe button, hitting the bell for notifications. I do daily uploads during the week at least. And drop a like if you enjoyed the video at all. Drop a comment if you have any words you would like to share with the class. And I will see you guys on the next one. Peace.